Hi, everybody. Welcome back to another episode of the Discovering Multifamily podcast. I'm your host, Anthony Scandariato with Red Knight Properties. And today we have a special guest here with us, Spencer Gray, who's the founder of Gray Capital. And Spencer's been around. He's got extensive commercial real estate experience since 2006. So he's been through different cycles, and he has amassed a portfolio of real estate assets of over 9,000 multifamily units and dabbles in some other real estate asset classes as well. So definitely want to hear his story on how he was able to start and grow and scale his portfolio, and then get into some of the current events that we're seeing today happen in the marketplace and where he thinks the trajectory of multifamily housing is moving forward for the next 5-10 years plus. So really happy to have him on the show and excited to hear from him. So thanks for coming on, Spencer.
Hey, Anthony, I really appreciate you having me on. I've been looking forward to this, and looking forward to having a good discussion.
Sure thing. So you start out just buying real estate out of high school pretty much, or what was that
Yeah.
story?
So essentially, it was actually just before I graduated high school. I had a great opportunity. One summer, a friend of mine whose father, he was an attorney, he had been flipping houses, and he wanted to kind of teach his son how to do it. Kind of told his son he needed a partner, which ends up making sense because you need partners on real estate. The reason he needed a partner at that time is because I think my friend was going off to summer camp and needed somebody to do all the work. And so I ended up getting stuck with doing all of the work. And so that was in 2006, 2007 time frame. The real estate market had been very hot. But as we were kind of going to sell that property, it was a low end house flip, and credit started tightening up. And the folks that we were hoping would be able to buy that property, because back in those days, liquidity was it was so easy to get a mortgage. You didn't really have to have an income. You could make up your income. And so as long as you basically showed up, you could buy a house. And that was kind of who we were targeting, because that's what my friend's dad was doing. And, we ended up learning a pretty valuable lesson as we saw the mortgage market kind of tighten up, just before the recession that happened in 2008. So that kind of taught me lessons. That was, my first real estate deal. I went on to continue flipping, more after I finished up college. I went to Indiana University. I was a music major at first. In general, I've always been driven to be an entrepreneur. Some of my parents started a business and grow a business, and I kind of want to do the same. Wanted to do that in the music industry, but following my passion, not really following my head too much, because I, thinking back, I don't know how I was going to be able to, build a profitable business in the music industry. That led me to continuing to flip houses, but I wasn't making any money on my music, and eventually started another business. Unrelated music, unrelated to real estate. We were brokering hops for the craft beer industry that was growing kind of in that 2012, 2013 time frame. Built a pretty large business doing that. We're exporting to breweries, all 50 states, exporting internationally. And then in about 2015, sold that business. So it wasn't really that scalable, but we had an opportunity to sell it. And at that time, all I was doing was reading all about different real estate investing strategies. And I kept learning about and coming back to multifamily, buy and hold multifamily. And I'm like, this makes sense, because I didn't want to flip houses anymore. I was tired of the burning and churning, kind of waiting for the music to stop. I wanted, that be able to create cash flow, long-term wealth generation. And multifamily really seemed like it was the ticket. And so I just started networking everybody that I could ever, who would, take 10 minutes to sit down with me. My wife was involved at the time. She had helped me start the other business, the hops business. And eventually I found a great partner who was kind of looking for kind of a strategic capital partner. And I didn't really know what I was doing in multifamily. And so I wanted to leverage his experience. And, we formed, a partnership in where we started co-sponsoring and co-GPing his projects. He was already syndicating multifamily deals, but he was trying to grow. It needed some, kind of just some more jet fuel to kind of keep his operation running. And we were kind of that jet fuel that kind of moved him to the next level, allowed us to gain experience, kind of learn from the inside, build our portfolio. And eventually, after doing a little over a dozen co-sponsorships with that group, quite a few limited partner investments as well, we started sponsoring our own multifamily acquisitions, primarily in the Midwest.
In the Midwest. Okay, great. So
Yep.
you have a very specific niche. Can you talk about that niche a little bit? As you know, we were discussing before, you see a flock to the Sun Belt,
Yep.
to lower tax states and more business friendly, at least right now in the current climate. So what is exciting about the Midwest, and how did you choose? What states are you in? I understand you're from Indianapolis, so love to hear more about
Yeah.
that as well.
And so, I mean, that really was it. I mean, it wasn't, we didn't start by saying, let's look at all 50 states and let's pick the one market we're going to target. It really started, because again, I had come out of flipping houses, being passionate about, kind of fixing up my community. I saw neighborhoods that were growing and I wanted to be a part of that, that culture and that growth story. So, I was very passionate. That kind of led to, all right, I want to do the same thing with apartments in Indianapolis. Indianapolis, Indiana in general is also, it's a very business friendly state, low tax state, relatively low, one of the lowest property tax states in the Midwest. But why? So we didn't really realize that Indiana and Indianapolis were really unique, just because that's what we were doing. We were in the thick of it. It wasn't until I really learned more about, I was really, just studying the market in general and studying other markets, learning about the Sun Belt, learning about all these migration patterns, and some advantages of other markets, that I really started looking at Indianapolis through a much more critical lens. And, what we found is that, we've got strong population growth, but it's not at the incredible clip that some of the Sunbelt states are. But what we found is we have a very steady growth, linear growth, but what we weren't seeing is the big crashes. So we weren't seeing the booms, but when a recession happened, we didn't see the entire market kind of fall out from underneath itself, like you saw, maybe in a Las Vegas, or you saw in Phoenix back in 2008, 2009. We have a very diversified economy, but that's all good and great, but really what creates kind of the sweet spot and why we continue to invest in the Midwest, because we look all over the US now throughout the Sun Belt, but what keeps us coming back is the fact that the solid fundamentals, but it's not overcrowded. We don't have capital rushing in by the trillions, maybe by the hundreds of millions, maybe $1 billion, but we're not seeing just floods and floods of capital driving prices to a point where you're not going to be getting any cash flow. And part of our objective is, we are really cash flow focused investors. And so, Indianapolis specifically and a handful of other Midwestern markets can produce this really nice balance of solid cash flow with a decent amount of appreciation. Now, that being said, not every Midwestern market is created equally, and I think that's the big difference between the Midwest and the Southeast or the Southwest, where you can go into the Southeast and essentially throw like a dart at the board, and you're going to pick a market that's got like awesome population growth, or some kind of growth story, just because of migration patterns, or in most secondary, tertiary markets, at least in the Southeast. But the Midwest, there are the Clevelands and like the St. Louis markets, which are not horrible, but they don't have they have Cleveland has negative population growth, and there's a lot of Midwestern markets that have either very stagnant or even negative population growth. And so you have to be careful of picking the right markets, but also kind of even more granular than that is really the right locations, right submarkets within those markets that are experiencing that growth. And so being from Indianapolis, having that knowledge, having that experience, we ask ourselves, well, why should we go to, an Atlanta or a Dallas or a Charlotte, which are excellent markets, but we don't know those markets as well. We're not going to get the cash flow. And, we don't know what we don't know when we have a market where we can produce consistent returns, especially in terms of cash flow. So
Right. No, that makes a lot of sense. It's always good to invest where you know. So
exactly.
after those co-sponsored deals, were those opportunities all in Indianapolis or in the Midwest as well, or were those in different states?
Primarily in the Midwest. A lot of them were in Indianapolis, and then pretty much all of the growing markets in the state of Indiana. So Bloomington, Fort Wayne, Evansville, Lafayette and West Lafayette, South Bend, and kind of the Granger, South Bend, Mishawaka, MSA. We're invested in all of those markets, as well as Ohio, Kentucky, a little bit of Tennessee, which is really kind of the South, but it's sort of close for us. Kind of the only market in the Midwest we don't look at is Illinois because of high property tax, and just not very business friendly at all. So
Yeah, no, no, totally understood. So you'll be able to learn from, your partner that you had at the
yep.
time in order to do, become the lead sponsor on your own deals. So, how many units are you at now, and where do things sell for? At least in general, we're recording this at the end of, middle of 2021 on
Yeah.
a price per unit basis. Because I've seen some things that are 10, 20,000 a unit, 30,000 a unit, and I talked to someone. He's like, yeah, I got 50,000 units, and I'm like, well, how much do you pay for all that? He's like, yeah, like 20,000 a unit. I'm like, whoa,
Ooh,
that's like
that's a
nothing
nice
compared
basis.
to on the East Coast. Yeah.
Yeah. So are you asking what we've paid for past properties, or what the market's looking like right now?
Well, what you have paid for, what the market's
Yeah.
looking like, and then kind of what the trajectory is of
Where we see
maybe
it
just in
going.
general multifamily, and then Midwest specifically.
Yeah, no, absolutely. So, I mean, a good deal in the Midwest right now for let's call it a C-class property, maybe B minus, is still going to be kind of in that 50 to 60,000 a door range. I haven't seen any kind of 20 to 30 a door for really quite some time. Even a couple of years ago, kind of like 40 a door was be really at the low end, and it's going to be pretty heavy lift. We bought a property last year for right at 50,000 a door. So I mean, like, you still can find some of those deals, but and there's usually a little bit of meat on the bone in terms of what you have to do. But then if we kind of go up the kind of the quality spectrum, different classes. If you're looking at more of kind of like a B class property, it's going to be more in that really 75 to call it 110,000 per door range, depending on how much opportunity there is. If it's completely stabilized versus if you should go in and renovate each unit, and it's really more of a value add opportunity. And then kind of even going up further from there, for more of kind of your Class A, A minus, Core Plus projects that let's say early mid 2000s, that those are going to be kind of in that $140,000 per unit range today. Now, last year they may have been 110 or 120 or 130. I mean, there was a property that sold, end of 2020 for, I think it was like 130. That same property today would probably sell for 140 a door, just several months later. And so the market has moved so fast in the past 6 to 12 months. It's really incredible, especially in the really not just the value add space, but also kind of that core plus space, as well as a lot of folks have moved kind of up into that B plus A class range, as the cap rates for kind of B and C properties have compressed just closer to those kind of the A class properties. And people are going in just for more of a yield play without doing that much work, adding that much value, but just still kind of harnessing the momentum of the markets themselves. But then, really kind of at the top of the market, new construction, we're seeing, closer to 200,000 a door, kind of depending on what it is and the location itself. And so that's certainly elevated from a couple of years ago.
Right. And you mentioned your cash flow focus. So on, a yield basis, and also it depends upon how many units you're buying at a time.
Yeah.
So I'm not sure what your average deal size is, but obviously the yield, your cash on cash return or your cap rate,
Mm-hmm.
but not or, they're two different things. But what are you generally seeing in the Midwest in Indianapolis for 50 unit value add, or actually core plus class, maybe B minus, C plus,
Yeah.
workforce housing type of deal? What are you
Yeah,
usually seeing?
it comes down to the little bit of the business plan. Sometimes doing a big value add, cash flow is going to be lower in the first year, and it's like our typical value add business plan that we're seeing these days. We have about 5 to 6% cash on cash year one. Then once the business plan has mostly been executed, we've raised rents on some of those renovations. We're seeing cash on cash kind of in that 8 to 10% range. That's more or less typical. For a more stabilized project, we're seeing cash on cash in kind of like the 7 to 8% range to start, and hopefully, trending to double digits over time. a lot of our deals are averaging cash on cash, kind of that 9 to 11% range, kind of depending on kind of the profile of the project itself. So, still, pretty decent, cash on cash. Interest rates being so low have really helped us on our newer acquisitions. And then, kind of inflation and rent inflation has really helped us on all of our existing assets to kind of boost up some cash on cash past
Right.
couple months.
Right. No, that makes sense. So what do you think, is going to happen once the rates rise in a market like yours where you specialize in the Midwest? Is that really going to change the real estate values relative to what you have as collateral right now, what you took out on the
Yeah.
property, given the low rates and what maybe the property might be worth a
Yeah.
year or two from now? How do
It's
you look at that?
it's interesting. I mean, we see it's a double-edged sword. So, interest rates go up, but that means we've got some serious inflation that's going on also. And so interest rates are going to go up. Maybe cap rates are going to go up slightly, or maybe they just stabilize because there's still so much investment demand that, they're kind of keeping cap rates where they are. And that's what happened in, 2018. We saw interest rates rise significantly, but cap rates really kind of just flatlined. They didn't go up. If anything, they went down a little bit, and then when rates came down, cap rates continued to go down further. If I knew where interest rates were going to be, obviously I'd be a multi-billionaire because I could just make a couple bets on the bond market. But I don't think interest rates. I can't see with the amount of debt that the U.S. federal government has that they are going to allow interest rates to rise too much, just because they're not going to be able to service the debt. And if we look at where the 10-year Treasury has hovered, kind of peaked at kind of 175 basis points. Now it's back in 130, 140 basis point range. That's kind of signaling that maybe we're seeing growth in inflation, but it's not kind of going to blow everything out of the market, and the Fed is going to have to step in and significantly tighten. They have been talking. Jerome Powell has been talking about they're going to be at least thinking about raising rates, but I think it's going to be very moderately to kind of just pump the brakes a little bit, which frankly would be pretty healthy, because the type of asset appreciation and asset inflation that we've seen, again, just the past 12 months, it's been incredible for owners, but it's not sustainable, because we're seeing rent growth, significant rent growth in a lot of markets. I mean, in Indianapolis, I think we're at least 5 or 6% over the whole metro. We have submarkets that are 12%, some submarkets that are 16% year-over-year rent growth, like crazy numbers. You have to do a double take. But we have to see wage growth, which there's pressure on wages because all these jobs are hiring people back. No one wants to come back to work because there's been unemployment benefits. Those are expiring, really kind of in the next couple of weeks, at the end of July. Some states are a little bit after that. We should see pressure in wages, because if McDonald's is paying $15 an hour, you're going to see those other jobs that are slightly higher skill level kind of pushing up as well. But are we going to see 16% wage growth, 20% wage growth? It kind of has to, rents can only rise so much if wages are kind of lagging behind. So, wages are kind of the anchor and that floor, or they put a ceiling, not a floor, but a ceiling on rent growth. So I think that's what we're going to have to kind of watch for, is that we don't get too far over our skis in terms of asset inflation and where cap rates go, just so low, because we don't see that wage growth to go along with it. So I think that's the biggest question is, how much. I know we're going to see wage growth, but how much? And if we don't see enough wage growth, that'll be concerning for me.
Yeah, no, absolutely. Especially if you're trying to raise rents, and every single apartment owner is looking at when they have a tenant come in and they're screening them to rent at the property. I mean,
Yeah.
I like to see 3 times the rent in their salary, their
At
gross
least.
salary, right? So if that's not keeping up, then we have other issues. You'll have collection issues. You'll have tenants that shouldn't be renting from you, and a whole host of other issues. So totally agree with that. And you were around in 2008, 2009, although it wasn't 100% larger multifamily deals. It sounds, this recession is a lot different than last time. It was more of a credit crunch.
Exactly. No, I mean, they couldn't be they couldn't be, further apart and more different. And, because last time it was a financial crisis, led by housing, and this is like a medical crisis, and then kind of like a government crisis. But then the government has intervened to such a different extent than they did back in 2008. And then real estate values, where they got cut in half in 2008, they've gone up by like a third, in this recession, which kind of surprised everybody. And you were probably doing the same thing last year. Everyone was kind of battening down the hatches, being like, okay, what's our collection loss going to look like? And are we going to see, loss of only 75% collections, 80% collections, 60%, kind of stress testing what our properties could do, bring reserves in. Some folks were suspending distributions, and then what ended up happening is we're seeing record occupancy, and we've seen record rent growth, and which in a recession you would think you would see a year of rent declines, but we had the exact opposite. So liquidity is the other big thing. I mean, banks stopped lending 2008, 2009. Banks have continued to lend, standards have tightened, and the standards, prior to the recession were pretty strong, whereas 2008, the standards were, there were no standards. We were talking about you could get a mortgage with, essentially no income. So yeah, it's in a different world. I'm concerned, not necessarily specifically, but we've spent trillions of dollars, and we've kind of changed the economy, and I don't think we know what all of these consequences are going to be down the road. I'm optimistic kind of by default. I think we're going to kind of keep moving forward, and we're an entrepreneurial nation. We kind of make the best out of things. So I have high hopes, but certainly there can be some compound effects that we're not seeing, and some black swans sitting out there, because we really have altered the way that the economy works and the expectations for the future. I mean, I think that most people now believe that during the next recession, there's going to be, a bailout for just about everybody, because that's what they learned in 2008 when they just bailed out some of the big banks. Everyone got incredibly upset, rightfully so, because they just bailed out a handful of folks. This time around, everybody's getting a check, bailouts for all. If that's the default, I mean, arguably say that it worked out pretty well. It saved us from a lot of pain, but there's nothing free in life. And so, somebody's got to pay at some point. And now, are we seeing that with elevated levels of inflation, where the purchasing power is just being destroyed, and the power of the dollar is being destroyed? Perhaps. I mean, that's what kind of economics teaches us, but it didn't really happen in the last decade either, when we thought that we were going to see rampant inflation because of the quantitative easing and money printing. So, I'm a student of economics in terms of I'm fascinated by it, but I'm not an economist. I'm just absolutely fascinated by kind of watching the soft science of economics, because nobody knows. Listen to the Federal Reserve, Jerome Powell, they don't know either, which is frightening, because they are controlling the economy and setting the price of money.
Yeah, no, 100% agree. Spencer, how can my listeners find out more about you and learn about your company and want to talk to you?
Yeah. The best way is to hop on our website, greatcapitalllc.com. We've got a newsletter you can sign up for, learn more about the company. I'm on LinkedIn. Reach out to me on LinkedIn. Happy to get in touch with you. I'm also on Bigger Pockets. But if you just Google Great Capital, we should pop up right at the top.
Excellent. And if you liked what you heard and or saw today, if you can give us a rating and review on iTunes, we'd really appreciate it. It would help Spencer and my message get out to a greater audience. And check out Spencer's platform. You have another website in the making too, right? You were telling.
Yeah. So it's kind of this crazy side project. We were tracking, trying to track all these new research reports that come out, primarily because we have a newsletter that goes out every week, and we try to compile every multifamily or real estate research report that gets released in articles. And we were like, well, instead of doing this once a week, let's build a website that aggregates everything. And so we put together, it's called grayreport.com, and we call it a multifamily intelligence aggregator. We're pulling in dozens of RSS feeds. We've got virtual assistants that are kind of just sitting on websites that don't have RSS feeds, pulling in research reports, covering the entire multifamily industry, real estate, the economy. We have kind of all the best podcasts, YouTube videos. So if you're a multifamily investor, it's a we've built it as a great free resource to kind of just bookmark and stay up to date. So it's greatreport.com.
Awesome. Greatreport.com. So we'll have that as well in the show notes, and appreciate that, and appreciate you for coming on, Spencer. Hope to see you again soon.
Hey, absolutely, Anthony. I really appreciate having me on. This is great.
Thank you.